Okay, so here's the thing. In this world, everyone makes mistakes. I mean, take Will here. Obviously, Will's about to make a pretty big mistake. Come on, Will, what are you thinking? So when it comes to mistakes made in investing, it can actually hurt a lot more than just getting a bad haircut because it's your money that's on the line. So wouldn't it be better to know some of the mistakes made by beginner investors before you start? So that's what we're going to talk about in this video. 5 mistakes made by beginner investors. Okay, let's get right into it with our first mistake, and that mistake is walking away from free money. I was a financial advisor for years, and you have no idea how many times I sat down with people and I would look at all their options. So let's say their employer options, and I would see the potential of where they could be putting money with their employer. And so if they have a 401k available, if they have a 403b available, many times they had a match available. And there were so many people who were not utilizing their match with their 401k or 403b. They weren't adding money into their accounts. And there were many different people who said that they didn't want to because they wanted to invest in an IRA. And their friend told them they should put money into a Roth IRA instead of a 401k. And so if you have an available match at your employer, you are walking away from free money. So let's go over the math on this one. Probably the most popular 401k plan set up in the United States is to have a 50% match on up to 6% of your income. So let's say you make $50,000 a year and you put in $3,000. That's 6% of your income. So if you put in $3,000, the company is going to put in half of that. So they're gonna give you $1,500. Now, how in the world could you get an extra $1,500 in your Roth IRA? That has, of course, no match because it's not tied to your employer. If you put money into a Roth IRA and you made a 10% of return and you put $3,000 into that account, after a year, you would have about $3,300. You made 10%. Now let's go over to the 401k. So if you had a 401k with an employer that gave you a match of 50% up to 6% of your salary, you put in $3,000, just like you did with a Roth IRA. You put in $3,000, you made 10%, let's say at the end of the year. So by the end of the year, you would have the same $3,300 as you do with the Roth IRA, but let's say at the end of the year, the employer puts the match in. So now you have $4,800 in your 401k. So what's better, having a Roth IRA with $3,300 or a 401k with $4,800? Of course, it's over 45% more money to have your money into your 401k. All right, so hopefully you understand now that you shouldn't walk away from money. So get your match in your retirement plan. It's almost always gonna be the best thing for you to do. So now let's move on to the second mistake made by beginner investors. Okay, so our second mistake made by many beginners is an important one because a lot of people don't realize this mistake until later after they've made it. And that's choosing an investment style or an investment strategy. So what do I mean by that? Well, there are people who are traders and there are people who are long-term buy and hold investors. Not everyone is going to be the best long-term investor. Not everyone's gonna be the best short-term trader. So you have to decide what you wanna do before because you need to learn how to do it. Someone who trades approaches stocks completely differently than someone who buys and holds stocks. Someone who's trading stocks look at charts and they use technical analysis. They're looking at charts and patterns and they're trying to figure out behavior of what's gonna happen next. Now, someone who's a long-term investor, maybe they care more about the fundamentals of a company. Does a company make a good product? Does it have good management? Does it have great cash flow? Is it reinvesting that cash flow and growing it? So these are different ways of investing. Now, if you just want to invest in an ETF and hold it and just hold it for a long time, well, that's more of a buy and hold investor. But if you want to trade an ETF and figuring out when to buy and sell ETFs, that's a trader. And so you have to make the decision which one you're going to be before you start investing, because if you go about trying to be a dividend investor who's holding on to dividend stocks, but also trying to trade them somehow at the same time, it's not going to work out very well. So figure out your investment style or the methodology that you invest before you start. Okay, so for our mistake number 3, it actually ties in a bit with our mistake number 2. So when it comes to risk, it's very important to understand what risk is and how to manage it. So when it comes to trading, managing risk is actually a lot different than managing risk when it comes to long-term investing. So some of the ways traders manage risk is by using stop losses, so making sure they don't lose more than X% per trade. Also using things like the risk to reward ratio, how much they will lose versus how much money they can potentially gain in a trade, and something called the 1% rule, which is not risking more than 1% of your entire portfolio on any one trade. So these are all ways that some traders manage their risk. Now when it comes to long-term investing, they manage risk totally different. So when it comes to long-term investing, one of the most important ways to understand management of risk is through diversification. Now you've probably heard it before. It's the whole don't put all your eggs in one basket type thing, right? So you shouldn't have all of your money in one stock or 2 stocks, but maybe 12 stocks minimum. If you have your money spread out between, let's say, 12 stocks for an example, and all 12 of those stocks are in different industries, then you may be able to spread the risk or reduce the unsystematic risk of your portfolio. Because for example, let's say the real estate sector has a very bad year, but the technology sector has a great year. So suddenly the technology sector is up while the real estate sector is down. So they balance each other out. And that's why you don't want to have all your money in just the real estate sector, because real estate sector falls out and all of a sudden so is your portfolio. So another way that long-term investors manage risk is through asset allocation. And so there are different asset classes. For example, stocks are their own asset class. They're equities, right? So real estate is real estate. That's a completely different asset class. So if you have, let's say, a REIT or let's say your own property, those are not the same asset classes as stocks, nor are, you probably heard of bonds before. So bonds are different than stocks. Bonds are debt instruments, stocks are equity instruments. So having a portfolio of different types of asset classes also can help you diversify risk. Okay, hopefully now you understand a little bit about risk, why it's important. So let's go on to our 4th mistake made by beginner investors. Our 4th mistake is not having realistic expectations. I've sat down with a lot of people as a financial advisor, and a lot of people just don't know what to expect when they start investing. They think maybe they're gonna start investing a little money and suddenly, poof, I got $1 million in 10 years. And it just doesn't happen like that, especially if you don't make tons of money. Of course, if you make $500,000 a year, you can have $1 million in 10 years. It's not that hard. But if you make 50 grand a year, it's gonna take you a while to build up a portfolio that's worth $1 million. So let's go over some scenarios here. Since 1973, the best 10-year period that you could have had is from August of 1990 until August of the year 2000. Over that time period, you would have made a 20% rate of return annually. That is a crazy amount of money. So if you make $50,000 a year and you save 20% of your income, you would save 10 grand per year. If you had invested 10 grand per year from 1990 to 2000 on those months, you would have a portfolio worth over $310,000. That is a lot of money, but it's still not $1 million, right? So even during the best return over the past many years, you don't have $1 million over 10 years. In fact, from 1973, the worst 10-year period had a return of negative 3%. So in that scenario, if you had invested the same $10,000 per month, you'd only have around $84,000 per year. So $84,000 or $311,000. I mean, big difference. Okay, so our 5th and final mistake is not investing enough money. And by the way, I made a whole video about how much money you should save for retirement, and I will put a link for that right here. Or maybe here. Here? So there are some general rules of thumb when it comes to investing, how much money you should invest. Now, here's the thing. They're not 100% true for everyone. For example, let's say you're a little older, let's say you're 45, 50 years old and you haven't saved yet. Well, this probably isn't gonna work for you because you need to have some savings already. If you're 25 years old, this is totally fine. You don't have to have savings already. So if you saved 15% to 20% of your income every year until the time you retire, then there's a good chance that you're gonna have enough money. Say you're 30 years old and you make 70K a year. Now, if you want to invest 20% of your income, that's $14,000 per year. So if you invest $14,000 per year and you made 8% in 30 years, by the time you're 60 years old, you're gonna have $2.6 million. That's a good nest egg. And so this is what I'm saying. If you are able to save 20% of your income, you're gonna have a good amount of money down the road. So I don't want you to get discouraged if you're thinking that 15 to 20% of your income is just an astronomical amount of money. So here's the thing. Over time, you can at least try to get to this number. So for example, let's say you make $50,000 a year and you can only save 2% of your income. Well, you can only save $1,000 a year. Well, it's better than nothing, right? So save $1,000 per year. Next year, try to up it. Maybe you can get to $2,000 per year. Maybe you can get to $3,000 per year within the next few years. Try to get, if you made $50,000 per year, try to get to that 15%, which is $7,500. Try to get to that number and then try to push past that number to that 10,000. And that's how you should do it. No matter how much money you earn, if you can get to that 15 to 20%, invest that money, then things are gonna go well for you. Okay, so those are our 5 mistakes made by many beginner investors. Now, let's go do a little recap so we remember them all. The first one is walking away from free money, like if you get a match in your 401k. The second one is not choosing your investment style. So are you a long-term investor? Are you gonna be a trader? So you're gonna want to make sure that you choose your investment style. The third is not understanding risk. So for example, managing risk when you're a trader versus a long-term investor, they're very different. And just generally making sure you understand risk. The fourth is having unrealistic expectations. So you're not gonna make $1 million in 5 years if you don't have tons of money to start investing. It's a marathon, not a sprint. There you go. And our fifth mistake made by many beginner investors is not investing enough money. So if you don't invest enough money to get yourself to retirement one day, it's gonna be tough. Okay, so thanks everyone for watching. If you like this video, leave a little like, that would be great. And don't forget to hit the subscribe button so you can get more of these educational videos that come into your inbox or wherever they go. So that's all we have for today, and we will see you in the next video.